And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa CIB, recognized by Euromoney Cash Management Survey 2024 for pioneering cash management solutions for their clients. Good evening. Welcome to the program tonight. I suppose the big figure that we should really focus on above all else, it's not about, food price inflation. It's not about multi-choice and their declining subscription numbers. It's this figure, 274,000. That's the number of jobs that Stats SA says was created in the third quarter of this year. And I want to believe, and I cling to this hope that this is the impact of the end of load shedding. And I say that because this might then mean that some of this is sustainable. In other words, yes, it might not be 274,000 every quarter, but that we'll start to see more and more people entering formal employment. I'm afraid the rational part of me probably knows that actually there are going to be a lot of obstacles to that, and that may not be possible, and that there's seasonality, and that there are a million other things, and that Donald Trump and tariffs, and that the gold price, and mining, and the rain, and all sorts of other things come into it. And we'll focus on this a little bit, of course. I mean, it's perhaps the most important I think it is the biggest and the most important long-term problem we face is unemployment, and particularly youth unemployment, and it is regional, and it is historic, and these are some of the issues that we'll deal with. I also very interested. I understand in the construction sector there have been some increases, and you may recall from time to time I've banged my head on the table and said, but where is the construction site that we've been promised? We keep being told by various political leaders that the country will be turned into a construction site. Well, maybe slowly, please, let's hope that is actually beginning to happen. MultiChoice saying that their TV subscribers are down 10% year on year. And in some ways, it's no surprise. They've been hit by all sorts of issues, the devaluation of the Naira in Nigeria. They've had problems as well with load-shedding power cuts in Zambia, which means that people haven't renewed subscriptions. But their big story is around the rise in the number of subscribers to Showmax, their streaming option. And it's kind of textbook, isn't it? There's still questions around Canal Plus and that merger. And they said today, and they've reconfirmed, that they've handed in documents to the regulators at the end of September. And as you know, there are sort of regulations that suggest actually a foreign company, and Canal Plus is, yes, French, may not be able to take over MultiChoice. There's a lot going on here, and we're not privy to all of the information, and that's just the way of things at this stage. But it's fascinating to watch what is going to happen. And of course, control over media, bit of a hot issue for various reasons at the moment. And then a comment from the group Bidcorp today. They suggested that food price inflation, I think the phrase was all but dead, down to 2%. Now, of course, there's a lot going on here because you've got maize prices where there's a little bit of a shortage of maize. We didn't produce as much as we normally do. Other countries like Zimbabwe need a little bit of help from us. We'll hear more about that from the CEO of the Premier Group in just a moment. But that also then takes into account the big shift that we saw after the pandemic. We saw in some places in Europe, food price inflation was 40%. Now, thankfully, we were spared that here. But still, food price inflation was sustained for a long time. The risk, of course, is that even if Donald Trump becomes president of the US again, as he will, and then imposes tariffs, say, just on two countries, Mexico and China, that you might think would not directly have an impact on food prices. Here, it shouldn't. But just the impact of global trade, and we forget the role that China has played in the last, call it 20, 30 years in exporting deflation. In other words, making everything cheaper just because of the sheer price at which they were able to produce. Became the workshop of the world. And that's had a big impact on the price you pay for literally everything. And that process seems to be coming to an end. But still, let's cling to 274,000 for the moment. 12 minutes after 6.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app
and DSTV channel 856.
A strong update from the Premier Group this morning. Its half-year profit up by over 32%. That's to the end of September. The maker of snowflake flour and blue ribbon bread saying group revenue up by nearly 4%. That's to nearly 10 billion rand, despite what it described as a challenging environment. The CEO at the Premier Group is Kobus Gertenbach. Kobus, good evening to you. You invested in new equipment, bigger bakeries, things like that. From your numbers, it would seem those investments are paying off.
Yes, thank you, Stephen. I think that, we've been at this for many years. I mean, we've invested over 6 billion rand over the last 13 years in our facilities, and the efficiency that we continue to drive out of those facilities, and on the distribution side, the efficiency with which we get the product to market has really helped us in this period where, between the election and consumer spending being under pressure, and not really driving significant volume growth for us.
I mean, you do make staple products. Bread and flour are just some of them. I mean, that does mean that you can kind of rely on robust demand. In fact, your major problem is probably your competitors.
It's always in a staple environment, a highly competitive environment. I mean, we've got very large competitors that are also produce good quality products and that are strong competitors to us. But I do think that, especially within our wheat supply chain, our Soflake brand is quite an iconic brand in South Africa. And we've managed to really change the game on bread quality through our Blue Ribbon offering and BB in the KZN market. And that has really come to the fore, and the consumer supported us as a result of that.
There's been a little bit of talk, Kobus, about a possible maize shortage. Shortage might be the wrong word, but we haven't produced as much of it as we would have liked. Is that going to affect your group at all? I mean, it's a massive ingredient for what you produce.
Absolutely. I mean, super maize meal is still the bulk staple for the largest portion, especially of the most vulnerable part of our society. And the shortage of the harvest this year has been exacerbated by a really bad harvest north of our borders. And so South Africa's maize harvest is not only smaller than what we used to, but it's also been exported in quite big numbers to our neighboring countries to assist with their feeding. And the combination of that has really culminated in exceptionally high maize prices. I mean, as we stand today, we are almost at 6,000 rand a ton, which I haven't seen in my career with Premier in the last 14 years. And that means that the super maize meal product is becoming very expensive. We've got enough physical maize to see us through this season until the new season becomes available from April onwards. But we certainly will, in my view, see some substitution effect where, especially as rice prices come down significantly, consumers may choose to rather buy rice than maize meal, which might be almost priced at the same level.
I mean, we see that kind of substitution from time to time. There are more people eating noodles than potatoes because potatoes have A, become expensive, but B, because they're difficult to cook when electricity prices are so high. Is substitution becoming a bit more of a risk for your group than it was maybe in the past?
It is. It's always a concern, but I think that the transaction that we did earlier this year in teaming up with the Gold Keys International and really entering the rice category ourselves as well, in partnering with the family that have built up that business, really gives us exposure to that category as well. And I think that as consumers move between the various staples, we're happy to trade and give them a value offering irrespective of which category it's in.
You have a big operation in Mozambique, and in fact, EBITDA for your section in Mozambique, this is the sort of groceries and international results, that was down by 2.1% because of what you describe as the macroeconomic conditions there. Clearly, that had a big impact on you.
Yes, we've got a magnificent business in Mozambique. It's an integrated business where we do wheat milling, we do maize milling, we produce pasta, we do a lot of biscuits, and we do animal feeds. And the country has really been going through a very difficult time macroeconomically. And I think that has now translated into some political unrest. And certainly in the last 2 weeks, post the election there, we've seen a very volatile environment. And unfortunately, our Mozambique business is a very small contributor to our overall profitability, so it's not impacting us that much at a group level. But we surely hope that some amicable and peaceful solution can be found to the political impasse that they seem to have at the moment.
I mean, an opposition leader today called for more protests in that country, in the capital and in provincial capitals. I mean, it doesn't look like this is going to stop anytime soon.
No, absolutely. And over the last 2 weeks, we've had a number of days where we haven't produced any product in our facilities as we protect, first and foremost, our employees. And it's very difficult to distribute product out in a volatile situation like that is at the moment. So we are aware of that. We're managing on an hour-by-hour, day-by-day basis at the moment. And we first want to make sure that everybody is safe, and then try and see to what extent we can continue to service the market, even though it's quite difficult.
You've been through a quite protracted strike at Mr. Sweet. Went on for 11 weeks. It did happen after this reporting period, but that must have had a big impact on the group overall. 11 weeks is a long time for a strike.
It is a significant period of time, and any strike is always quite unfortunate because there is no real winners in a situation like that. The strike actually started in August, so we had about 5 or 6 weeks of it during the reporting period, with the rest of it being subsequent. We have resolved that amicably now, and everybody is back at work, and I think that it's for us now a matter of making sure we just bed down the relationships and start to get the optimal production out of that facility again.
You're confident the strike has been resolved for good? The issues aren't still there, aren't still going to cause trouble for you and for the workers in the future?
No, we've actually managed to conclude a 3-year wage agreement now. So at least for the next 3 years, we should have no further concerns around the disputes around wages.
Kobus Gertenbach, thank you very much indeed. CEO at the Premier Group on The Money Show this evening.
The Money Show
with Stephen Grootes.
Well, on the face of it, some good news from Statistics South Africa today, suggesting in the third quarter of the year, our economy created nearly 300,000 jobs. Of course, as you know, we have around 10 million people who are unemployed. Various definitions of that. But I suppose if you say between 8 and 10 million people, that really makes you realize how big the problem is. Isaac Matsegos, an economist at Nedbank. Isaac, good evening. This increase, is it significant? I mean, if we did do this every quarter, we should start to make a dent in our biggest long-term problem, unemployment?
Sure, Stephen. Thank you. The number is encouraging, but not so significant. We had just under 294,000 jobs created. Most of the new jobs were in the informal, non-agricultural sector. So that's a bit encouraging. But I mean, when we dig deeper into the numbers, we see that about 160,000 people stopped looking for jobs. So those are the discouraged workers, and with those people, the unemployment rate would have been about half a percentage point higher than what was reported.
Okay, so I mean, it's vaguely encouraging, but we shouldn't get too excited.
Sure, it is encouraging. I mean, you attributed some of it to the end of load shedding, and we can see, for instance, the improvement in employment in the mining sector. That definitely will be partly more stable electricity supply, and also, you know, a rebound in commodity prices. I mean, precious metal prices, particularly platinum group metals, have improved. Even gold, and those have encouraged more output. We've seen a turnaround, for instance, when you look at the mining numbers. So there's a bit of a turnaround in mining output, and that has helped to recover some of the jobs that were lost, particularly in 2023.
When we look at the fourth quarter, and we need to take into account seasonality, now there are perhaps some part-time jobs for the Christmas season, but I mean, can we expect, and particularly, you know, as the end of load shedding is kind of cumulative, in other words, people have more confidence that load shedding won't return, and thus maybe feel a bit more encouraged to take on more workers. I mean, is there any reason to believe this momentum might continue?
Sure. We will have to keep the grid stable in the final quarter to boost that activity in the services sectors, which do create those seasonal jobs. But going into the first quarter of the year, Stephen, unfortunately, as a lot of those jobs are seasonal, we tend to lose them. And again, you know, in the first quarter, the labor force increases by an average of between 300,000 and 400,000, with the most of the new entrants rather coming from the education system. So we still have a long way to go in creating the number of jobs that we really need as an economy to really address our socio-economic challenges.
There's a lot of talk, Isaac, about the change in sentiment after the formation of the National Coalition, but we haven't seen a lot of action. Obviously, we would need to see action to actually expect any kind of real change.
It is still early days, Stephen. Remember that after a very difficult period of almost 12, 13 years, the economy now has stabilized. What we've basically seen is, the GNU sentiment stabilizing businesses, and of course, real improvements such as better electricity supply. Those have basically helped to stabilize business operation costs. And now what we're looking forward to is a pick up in business investment, for instance, with businesses being more confident about policies. Because before the elections, there was a lot of concern about what policy direction was going to be taken after the elections, and of course that would have been determined by the government which came into power. So basically what I'm saying is that the GNU has helped to revive that confidence, because the GNU has continued with the prudent policies that are focused on infrastructure investment, on improving the business environment, on sorting out the SOEs as they dominate the network industries. So it's stabilization this year, and maybe for the first half of next year too. But after that, we do expect to start seeing real numbers.
And lower interest rates, that obviously gives things a nice little push.
Sure. And we're still expecting another cut at least in November. And going into next year, still more cuts, but we're no more certain about the number of cuts because, the situation has changed as Mr. Trump basically threatens to adopt inflationary policies once he takes power in late January in the U.S.
Isaac Motsecho, thanks very much indeed. Economist at Nedbank on the line to you this evening. And of course, when you've got 294,000 jobs being added, I think I said 274,000 earlier, sorry about that, 294,000 jobs being added, you'd like to think that this can be sustained, but still, as I say, so many obstacles in the way of that. 25 minutes now after 6.
The Money Show.
The markets.
Anthony Modasani is a senior equity sales trader at Absa CIB. Anthony, good evening. Thanks so much for coming in. Quite a strong trading update from Bitcoin. The market loved it. And a comment that food price inflation is all but dead.
Yes, thanks, Stephen, for having me. It's always good to be here. So Bitcorp, the market did trade weak into the results. It seemed like you had analysts expecting quite a soft update, and they came in and surprised and performed pretty well. The stock up 6%. We saw just shy of 3 times its average daily volume trade today. So, that just tells you it was a really solid update, and investors like what they read.
It's also a company that's very diverse across 5 continents. Now, usually that's a very good thing. That means that, things should balance out. Of course, if there's an international trade war, it gets a bit more complicated.
100%. They seem to have navigated it quite well. And they made mention of making a couple of bolt-on acquisitions and said that they still have a significant appetite for larger opportunities should they appear. So they don't seem to be shying away from it at all at the moment. They're happy to take on and be a global powerhouse. That seems what they're growing to.
MultiChoice, their linear TV subscribers, in other words, traditional TV subscribers down 10% as I understand the results, but Showmax streaming, up their subscribers up 50%. How do you view those results? Obviously, linear television's going downhill.
Yeah, 100%. We all know streaming's become the new fashion lately, right? Everyone's got Netflix, Amazon, and so on and so forth. So, I think they're really struggling in an environment like that. And I think, Showmax has been one of the big money spinners, and that what they've been pushing on and trying to get, to sort of break in. If you read in the results, they did speak about a very difficult time in Africa with significant churn, and they spoke about, an extremely hostile operating environment in Africa specifically. So, it's always difficult navigating Africa. And like you mentioned, the Naira devaluation just doesn't help matters either there.
It's so interesting to see that Canal Plus is clearly dead keen. They really want DSTV,
yes,
despite all of these problems. There's something there.
Yeah, no, 100%. I think they're all in. They're happy to be there. I think that's what's underpinning the share price at the moment. That's why you didn't see too much of a reaction. The stock was up about 30 odd basis points on the session, and that 125 offer is really anchoring it at the moment. I believe that Canal Plus should be listing in the UK market in the next couple of months as well. So it just seems like it's still all systems go, and we'll have to hear what the tribunal has to say about it and what the outcome is.
And an update as well from AVI today.
Yes, so they seem to have, it felt pretty balanced, but it feels like a lot's going to be weighing on December, for the Spitz business. So those kind of things are really dependent on a good trading season in Christmas, and if that feeds through for them, then that could be pretty supportive. Interesting price action for the stock today, and it also had decent volume trading on it as well. So definitely a bit of a tug of war between the bulls and bears there. But yeah, let's see what happens. It did feel pretty balanced in my opinion, but yeah, we'll have to wait and see what happens after Christmas.
And then Vodacom recovering quite strongly. And I noticed Telkom shares up too. Vodacom, their shares had been down really since that Competition Tribunal ruling that Vodacom and Vumatel could not work together in the fibre business. Why did their shares recover today?
So I think it was pretty interesting. It was a soft update of first half numbers, and but also again it's the Africa element, right? Operating in Africa just proving to be very difficult for our JSE companies here. But if you looked past that, the earnings were flat. So yeah, they've got a lot of work to do for the second half, just to catch up to analysts' expectations. But all in all, if it's a flat result, I think maybe the market just felt a little bit more of an overreaction yesterday, and trying to recoup a little bit of those losses yesterday.
So it's the typical thing. Everyone has a think about it overnight, and they sort of go back to normal.
100% one of those. It actually wasn't that bad. Hang on, let's rethink it.
Anthony Modasani, thanks very much indeed for coming in. Senior equity sales trader at Absa CIB. Coming up in the next half hour, we'll be talking about, and I'm sure this happens to you all the time, the sheer number of people who phone you trying to sell you something. I've already used the phrase bang my head on the table today, but it can actually almost make your phone unusable. You just don't accept landline calls. Well, some new regulations in the works around that. And then also the impact of tariffs, if they do come in from Donald Trump back in the White House. If that were to happen, what that would do to food price inflation. That's next on The Money Show. Just gone 6:30.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, I forgot to invite you earlier to join us in the program. 011 883 0702 021 446 0567. I don't know how you've changed your viewing patterns. I mean, is there a future, do you think, for sort of live action TV? And obviously this takes you straight to sport and the live shared event and perhaps rolling news. We've seen during the pandemic how important that can be. Very difficult to know how it's all going to play out and sort of shake out in some ways. But certainly a lot of money being put in certain areas of broadcasting at the moment. By broadcasting, I do include streaming for the moment. There's clearly a lot of money, and there's clearly all sorts of bets being taken one way or another about how things are going to go. I don't know if you have a view, or if you've sort of given up on what you were doing and now you just do the simplest thing. I think for a lot of people, whatever you were doing, trying to make it simple in terms of what you're watching does make a big difference. I don't know how often you get phone calls from people who just try to sell you something. I find I actually almost, and I've told you this before, lose the ability to use my phone, because whenever it rings, it's actually someone trying to sell me something. Drives me mad. I'm sure it drives you mad too. And for some reason, the finance companies are the worst. I mean, it happened to me twice yesterday. They phoned again today. And you say to them, do not call me again, as I understand the law. They then are not supposed to call you again, but they do anyway. Now the Department of Trade, Industry and Competition is looking at introducing new regulations to, I suppose, give you your phone back. Ashlin Perumall, a partner at Baker McKenzie South Africa, looking at the proposals. Ashlin, good evening. What kind of changes are being proposed here? And please tell me they're going to work.
Stephen, thank you so much, and great to be here. So the department's proposing some very interesting developments. This is going to establish these amendments. They're going to establish an opt-out registry that is going to be managed by the National Consumer Commission, or the NCC. Now, this registry aims to do two things to combat what you're referring to. The first, with respect to consumers, is allowing consumers to register a preemptive block by completing a form and submitting information to the NCC, providing information like email address, telephone numbers, etc. And there's no fee for this. So per the Consumer Protection Act, there's no charge to consumers for putting this preemptive block in place. What this then means for direct marketers, which would include the likes of the telemarketers that you refer to, is that they now need to register themselves annually with the NCC by completing an electronic form. They'll need to provide identification information so that you know who they are, so that the registry knows who they are, and so that their information that they're using when they're direct marketing is quite clear. And then, and most importantly, they'll need to do two things. They'll need to maintain their own databases of records of people they can call by checking against the preemptive block registry and essentially removing people who have registered an interest not to be contacted. And they must obviously then not contact any consumer who has registered on this preemptive block for direct marketing. So what this is aimed to do is really strengthen consumer privacy by handing a lot of this control back to the consumer in a very interesting and important way.
I'm sure that there'll be people who will argue against it, and they will say we would not do this if we didn't actually make money from it, if we didn't get, new business. And they will say that they employ people and that those people will lose their jobs as a result. And I'm sure they'll make that submission to the minister.
No, absolutely. And I think we could definitely expect a challenge. Similar provisions under our privacy legislation, the Protection of Personal Information Act, have also been brought to the fore by telemarketers. So this is definitely going to be met with some challenge. These regulations are not yet final. They're open for public comment by 15 January. So this is still open for public debate. That being said, I think to some extent the industry does need to mature in South Africa. The like of these registries is not a new concept. You see them in countries like Australia, where it's called a do not call register, in India, the National Customer Preference Register, and even in the United States with their National Do Not Call Registry. So this is not a new concept. To a large extent, I think these businesses will need to become much, much more compliant and respectful of consumer privacy and their choices when they engage in these business practices.
Okay. At the moment, Ashlin, as I understand the law, you'll know it better than I, if I tell a company, do not call me again, and they do, they're actually breaking the law. They're also breaking the law by getting my information in the first place. If they say, hello, Mr. Grootes, and I've never given them my information, they're supposed to tell me where they got it from. And they always say the same thing, oh, my manager gave it to me, and they can never answer. I mean, it doesn't matter what you do, you'll never get you'll never find out how they got it, and that's because they broke the law to get it. They bought it from someone. So I suppose my point now is they're breaking the law now. Why are they going to follow it once these regulations come in?
So what we've seen, especially in 2024, is two of our regulators, the one being the information regulator, but the other being the body that oversees consumer protection, taking a much harsher stance against telemarketing and direct marketing. So the enforcement mechanisms that are available under this piece of legislation is, firstly, you can impose a fine up to 1 million rands or 10% of annual turnover. And you could also now impose imprisonment if an individual direct marketer does not comply with a compliance notice issued by the NCC. Now, if we look at the other piece of legislation, the Protection of Personal Information Act, we're starting to see that regulator take a much harsher stance. What they did earlier in February this year is indicate that the loophole that had been used by telemarketers around electronic communications, they argue that telephone calls aren't part of electronic communications. The regulator in February said that they do. And this is an area that is going to allow the regulator now to seek more enforcement within the privacy space. I think if these new regulations under the consumer laws come into effect, I think you've got a two-pronged attack, which I think over time we'll start to see a lot more compliance notices issued and a lot more enforcement happening by the regulators.
We live in an era of voice over IP. In other words, someone can make a call and call me from anywhere in the world for the same price as it would cost me from the same city of Johannesburg where I'm in now. So even if these new regulations come in, will we not just get calls from people in foreign countries, and that will just make it impossible to enforce?
I think that's very possible, and that's one of the areas that in the practice of how this is enforced we'll need to see as this unfolds. What I can say is in other countries where they have implemented such a do not call register, they have seen improvements. So, for example, in the United States, within the first couple of years of their do not call register, the count of calls went from 30 per month to about 7 per month. So depending on how this influences the legitimate businesses, this could have an impact. What will also happen, or may happen, is that the regulators will focus on those central nodes, essentially those central companies that provide these services as advertising services towards their customers, and make examples in respect of them. And I think that will at least reduce the count. I don't think this will completely resolve the issue. As you say, there's going to be various technological and other means to get around these, but at least the quantity of direct marketing and telemarketing should hopefully reduce as a result.
Do we have any idea of how big this industry is in South Africa? How many people on a daily basis are cold calling people and trying to sell them something? I mean, it's often not live people, but do we have any idea of how big the industry actually is?
So unfortunately, companies that provide caller ID services don't release that data. But what I can say is Statista, a company that looks at statistics and the business size of advertising spend towards telemarketing, they indicated that in 2024, the size of the advertising spend towards this industry is about 500 million rands, or about $24 million. So it's quite a large industry. It's not large globally. There's much bigger industries out there, but it's still a significant portion of advertising spend in South Africa. So it is an industry where there will be a lot of casualties in respect of businesses that can't adapt to these new compliance requirements.
It's fascinating that big brands that are very worried about their public image don't really do this. And if they do it very carefully. Someone will say, I'm phoning on, and they'll sort of say associated with, but they won't be from, if you see what I mean. And I presume that's because bigger brands who are worried about their reputation know that actually they will suffer because of this. It's fascinating to see which companies advertise in this way and which don't.
Absolutely. And I think it's an area of or form of advertising that may slowly start to change and fall out of favor for bigger brands, particularly as the two regulators I mentioned earlier start to seek making public examples of brands that do associate themselves with direct marketing practices that are not compliant with either POPI or the CPA. So I do think that a lot of the enforcement action may see a turn away from big brands towards this type of advertising.
Ashlin Perumall, thank you very much indeed. Partner at Baker McKenzie South Africa. Fascinating. I had no idea it was so big, 500 million rand, according to the numbers he has. But also, let's just hope that you and I get our phones back.
The Money Show with Stephen Grootes is brought to you by Absa CIB, pioneering cash management solutions for our clients, as honored by Euromoney Cash Management Survey 2024.
A strong comment from the Bidcorp Group this morning that food price inflation seems to have all but disappeared. You might remember food prices rising by about 12% on a sustained basis. At one point during the pandemic, it stayed very high for a very long time. Bidcorp thinks food price inflation will stick at around 2%, but, and I think it's quite a big but, a capital letter but if ever there was one, Donald Trump is going to be the American president from early next year. He's promised huge tariffs on goods from various countries around the world. Paul Makube is a senior agricultural economist at FNB. Paul, good evening. So food price inflation is low for us for the moment. If tariffs were to come in the US, could that change?
Good evening, Stephen, and to your listeners, and thanks for having me. Yes, definitely, we are enjoying, at the moment, lower food inflation, not only domestically, but globally as well, despite the challenges that we have on the international market with ongoing wars and tensions that are disrupting trade. So you talked about the situation with the election of the President-elect Donald Trump in terms of policies on trade, specifically on the agricultural sector. Indications are that, is likely to, or is inclined to impose tariffs on the Chinese, imports. And obviously there's going to be a retaliatory, the history is there that China will retaliate, and the impact of that retaliation is that the U.S. will also face either blockages or tariffs. But given the magnitude of the commodities that China imports and that what the U.S. is exporting, that will actually have a negative impact on the world market.
Sure. So, I mean, Trump really he's focused on two countries during the campaign trail, Mexico and China. Even if he just imposed tariffs on those two countries, and as you say, China, of course, would respond, I would presume in some way that would affect us anyway. Just the idea that you have someone in the White House who could wake up one morning and decide to impose tariffs on another country would have an impact.
Yes, obviously it will have an impact, but fortunately we have you have a few years of an experience of this happening, and obviously the first thing is that the U.S. farmers will be impacted, and obviously he has to converse them about the issue. The pork producers were badly hurt the last time this happened. And soybean producers, and that diverted, China's, imports to South America. Obviously, that will not be a good thing to do, but he's determined to do. And the impact is that, while the U.S. will be redirecting its exports to elsewhere. The impact is that you are likely to have lower prices in the short term if the Chinese are out of the market, because they are biggest importers of agricultural produce. Obviously, that has an impact on the domestic market from a pricing perspective, because most of our grains are import parity priced, and if you have lower international prices, obviously. That will have impact on the farmers, but on food inflation, obviously that is positive, for food inflation. Yes.
We produce food, and actually, in most seasons, we're a food exporting country. Could there be some opportunity here for us?
Of course, there is some, opportunities. Given that recently we have had, an entrenchment of engagements with China. We saw the opening of more agricultural produce into China recently, and obviously that creates an opportunity to import there. But if you look at the biggest commodities that the U.S. exports to China, which is pork and soybeans. We are, smaller players in the bigger scheme of things, but obviously, it is an opening. It could be an opportunity for the, domestic pork producers to, increase their exports to that market. But also the increase in production locally in terms of, soybeans. It's quite insignificant at the moment. It's quite small if you look at the domestic soybean market. Yeah, but in terms of other commodities, in terms of trade, it is imperative that South Africa actually diversify to other markets to ensure that when you have this kind of disruptions happening, you are well diversified. It provides you with a natural hedge. With the ongoing war with Russia and Ukraine, as well as the tensions in the Middle East, this is unlikely to, dissipate in the short term, and therefore, countries will be looking inward in terms of, domestic policies to protect their own environments. Obviously, China as well will be hoarding grains. In light of the Trump administration coming in, so there's going to be big demand for agricultural produce. It has that tendency to increase and buy a lot of grains and oilseeds to actually ensure that it is self-sufficient.
Paul Makube, we'll have to leave it there. Thank you, senior agricultural economist at FNB. 7:00.
And now, The Money Show
with Stephen Grootes on 702
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, recognized by Euromoney Cash Management Survey 2024 for pioneering cash management solutions for their clients. Good evening. In your second hour of your Money Show tonight, we'll be talking in a moment to Musa Mabesa, the Principal Executive Officer of the Government Employees Pension Fund. Not many opportunities to speak to him and to the fund, so quite a few things just to touch on. We'll also, after 7:30, Personal Finance, Warren Ingram, how to avoid January, which I suppose is the right thing to talk about after talking about pension funds. But Warren is really talking about how to avoid the traditional sort of financial hangover that is January. He's even going so far as to telling you how to decide who you're buying presents for. He's a very brave man, Warren Ingram. You'll hear from him in about 20 minutes.
702. Stephen is on the Money Show.
6 to 8 p.m.
Well, the Government Employees Pension Fund announcing final results today. It recorded growth of 2.6%. It gives the fund a market value of, hold your breath, 2.38 trillion rand. The fund says this is after an annual return on investment of 4.9%. The 10-year annualized return was 7.2% from the period from 2015 to 2024. In other words, over the last 10 years. Musa Mabesa is the Principal Executive Officer of the Government Employees Pension Fund. Musa, good evening, and thank you for your time on the Money Show. It's a huge amount of money that you're in charge of. It's a very big ship. Do you believe it's growing quickly enough? Which I suppose is really me asking you, is the Public Investment Corporation doing the job you wanted to do?
Good evening, Stephen, and to your listeners. Yes, I think the GEPF is growing at a steady pace, and in short, the PIC is delivering the numbers that we would expect under the difficult economic circumstances, both locally and globally as well.
You say one of the things you mentioned in your statement today was you're implementing the findings of the Nugent Commission. That made findings about the Public Investment Corporation, how it had been making investment decisions. I think there were some recommendations for your entity. Do you still have work to do there? I mean, are there still recommendations you need to implement?
No, I think the continued implementation relates largely to the relationship between the PIC and the GEPF, strengthening that, as well as strengthening the GEPF's oversight and monitoring over its investments that are managed by the PIC. So that's the ongoing work that we're doing. The bulk of the findings were for the PIC to implement, and they've continued to do so and reported to the Minister of Finance accordingly.
Do you conduct more oversight or better oversight now after everything that happened than you did, say, 5 years ago of the PIC?
Of course, we did learn a few things from the Party Commission of Inquiry, and from there we were able to improve the investment management agreement that we have with the PIC, and there's better oversight, of course. And the PIC is more transparent as well in its reporting to us.
Dondo Mokajani stepped down as your chair last week. There are allegations he received a bribe from VBS Bank. Important to remember, he strongly denies that, and this all goes back to when he was the Director General in the National Treasury. How is his resignation affecting the fund?
Well, that has not impacted the fund well. I think the resignation was handled professionally by both the former chair and the current board, and the Minister of Finance in his office also issued a statement. So I think that was handled well, and the fund continues to focus on its objectives, which is paying benefits and protecting those benefits of members through prudent investment.
He was also working as the CEO of the Motti Group. And that group's been the subject of a huge amount of reporting. And your fund is massive, which is why there's always so much attention around it. Was his work at the Motti Group a problem at all for the fund?
Well, all of our trustees have day jobs to the extent that they are employed or they're focusing on other things. So as non-executives, they were focusing on the fund's responsibilities whenever they were at the fund, and there was no link between the work that trustees do outside the fund and what they do in their respective positions as fiduciaries of the GEPF board. So, no, there was nothing to that effect.
Okay. You processed was just over 35,500 retirement claims in the last financial year. And the year before that, there were over 37,000 retirement claims. Are fewer government employees retiring, Musa? And this is really a question about the two-pot pension system. The suggestion had been before that one of the reasons we need a pension reform was that workers would retire early to get their pensions for whatever reason. The two-pot system is meant to stop that from happening. Do you think there's any link between the fact there were fewer retirement claims in your last financial year than the year before and the introduction of the two-pot retirement system? I mean, even though it hadn't come into effect yet, people would have known it was coming.
So we did hear rumors about huge resignations that would be coming just before 1 September, which was not necessarily a reality. So up to 31 March 2024, there were fewer exits from the fund. I think it's better education and awareness by our members about why it pays to be a GEPF member and to remain in the GEPF to be a pensioner from that perspective. So I think it's better education and members knowing what's good for them in remaining a GEPF member.
Okay, so all in all, for the moment, this was a good reform, and the consequences, as you can see them, are probably, generally speaking, keeping people in their jobs for longer.
I think the preservation component, being the 2/3 of a member's contribution from 1 September 2024, allows for members to retire comfortably and protects them from any challenges going forward in the event that they leave the system earlier than their retirement age. So that's compulsory preservation component, I think, does assist greatly for our members and all members of retirement funds in the country.
Okay. The Public Investment Corporation needs a new CEO. Abel Sitole's term ends in July next year. And Musa was reminded today, in fact, he once held your position some time ago. Do you want to be CEO of the PIC? Are you available? Let me put it like that.
Stephen, I am the Principal Executive Officer of the GEPF, and I'm still in contact with the GEPF.
Okay. So is that a no comment for now, at least?
Well, I'm working at the GEPF. I have an employment contract at the GEPF, so I'm focusing on my responsibilities as the PE of the GEPF.
Okay. As the Principal Executive Officer, are you involved? Do you play a role in looking for someone for that position? I mean, whoever it would be, you would work with them very closely.
Well, the PIC is a separate legal entity, so they would run their own governance processes, and the GEPF is not involved in that. We treat them as an asset manager like all other service providers. So we've got an arm's length between ourselves and the PIC.
Okay, I do hear you on that. Obviously, your job, what you do is you manage the pensions of government employees, and to an extent that's about the mandate you give to the Public Investment Corporation. And Musa, I'm sure you've seen speculation and occasional sort of comment that funds invested by the PIC could be used to implement the National Health Insurance Scheme, the NHI. Would you support that?
Well, to the extent that we know at the GEPF, there hasn't been any approach to the GEPF specifically. But the PIC invests. Firstly, they have a discretionary mandate, and they invest for the benefit of the fund, and they chase returns in line with the targets that have been set for them. So they would assess investments in line with the investment mandate as well as the return targets that we set for them. So all investments would be assessed based on their own merit. Yeah.
Okay, I mean, and I'm sorry to push this, but government workers. So there's some evidence that government workers don't support the NHI. And let me just state it because it is contested. But the Board of Healthcare Funders is opposing the NHI in court. One of its members is the Government Employee Medical Scheme, GEMS. The other is the Medical Scheme for Police Officers, POLMED. So now these are the two big medical aid schemes for government workers that are members of the organization that has gone to court to oppose the NHI. And that would suggest then that their members, government workers, don't want the NHI, which means then that it might follow that they wouldn't want their pensions to fund the NHI. And so and I think they would have a kind of a right to know what the view of the actual pension fund might be if the PIC were to do this.
Well, firstly, the two schemes you mentioned are medical schemes, and there would be some sort of relationship between the medical schemes and NHI. For the GEPF and by extension the PIC, investments again will be based on merit, return expectations, and to the extent necessary, the impact that those investments would make on the economy and our members at large. So there'll be many considerations in deciding where to invest some of the monies in line with the mandate that we've given the PIC. So I don't think I'm qualified to speak on health matters and the NHI itself. We focus on protecting the pensions of our members, pensioners and beneficiaries, and also monitoring the investments that the PIC makes in that regard.
Musa Mabesa, I know you don't do many interviews, and I think I understand why. It's a big ship that you run. Thank you very much indeed for your time on The Money Show. I really appreciate it.
Thank you, Stephen.
Musa Mabesa is the Principal Executive Officer of the Government Employees Pension Fund. Well, your view on that, please, on 011 883 0702 021 446 0567.
The Money Show.
The Africa Business Report.
And of course, that's with Dr. Rotendo Hundingwi, the founding director at Tribe Africa Advisory, author of Rumble in the Jungle Reloaded. Rotendo, always good to see you. Thanks so much for coming in. In Mali, the juntas detained 3 executives from the gold mining resolution. I mean, this is going to be a serious issue because it gets to the heart of what's really going on there.
It does indeed, Stephen, and always a pleasure to engage with you and your listeners on a Tuesday. So the Resolute, which is a mining company from Australia, has actually lost plus or minus 30% of its share value just because of this. The CEO, Holohan, was actually detained with 3 other colleagues in Mali. Mali is probably the 3rd biggest gold producer in Africa. It's in the same lines with Ghana, Burkina Faso, and South Africa, who are probably at the same level, and Sudan. So this is a result of, I think, the pressure that's happening in that Sahel region because of the militia taking over and facing sanctions from a global perspective. They're needing money, which is cash flow. I mean, Mali as a GDP is plus or minus $20.9 billion, a population of 23 million, and year-on-year growth of 3.4%. But the challenge that is happening there, they produce about 2.4 million tons of gold per year, and they're trying to find as much as possible with the sanctions and the pressures they're facing globally, how to get more money. So one of the things they're trying to do is squeeze the local multinationals, and by doing that, extract some money out of them. I think about 2 months ago, Barrick, which is a Canadian company, had to pay an $80 million fine. Look, in the bigger picture of things, with the gold that the guys make, it's nothing. But when you're trying to attract investors, create a stable environment of the economy, it obviously creates a bit of a discrepancy, and that's the challenge that you're finding there in Mali.
I mean, isn't it always the same thing? So a company will get into a country, and you see it time and time again in different places. They get themselves into a financial jam. They need money urgently. They squeeze some of the big multinationals. I understand why they select them.
Yeah.
And then that has a bigger long-term impact, and you lose more money in the longer run.
No, it does. And, the actual company itself has got a shareholding. I think the region is called Saim or Samaina, if I've got it wrong. But the challenge that is there is that it's a split ratio of 80-20. So Resolute owns 80% of the business and 20% is owned by the government. And really what's pressurizing things is that it's the sustainability of these sanctions, bearing in mind also Mali is one of the countries that have pulled away from ECOWAS. So that whole REC, or the regional economic system that's operating, there's also it's facing a lot of challenges. So it talks to the sustainability of these militia-led or junta-led countries with regards to the global economic environment, and that's going to create a lot of challenges.
So Africa needs more ships. I hope I said that correctly. But we need more ships to take advantage of trade opportunities. And I mean, on some level, it does make sense. And I don't mean ships registered in Liberia, as so many have been.
Yeah, so this is in line with AFCFTA. We know that the big thing about AFCFTA, they always talk these big numbers. They say, look, to tap into the $3 trillion opportunity that will be unlocked by AFCFTA. We've heard it a lot of times. It's slowly happening from country to country. But one key angle here is the blue economy. And they've estimated that in order to fully tap and unlock the blue economy or the trade leveraging off the seashores of Africa, 100 ships are required. Now, just to give you the size of the coastal size from the African perspective, there are 38 coastal and island states, 13 million square kilometers of exclusive economic zones, and over 47,000 kilometers of coastline. So this is all good. But it has to translate to economic power. The challenge that Wamkele has, who's the Secretary General of the AFCFTA, is firstly, when you look at the ECOWAS region, which is one of the key contributors to the AFCFTA, you've got obviously these 3 countries, Burkina Faso, Mali, and Niger, that have pulled out of ECOWAS. So there's political instability, so the chances of economic integration coming into play is also a challenge. The second component is that 2/3 of Africa's GDP is in the sub-Saharan region. Now, why is this a challenge? Because from an AGOA perspective, South Africa contributes 20% of the intertrade, or Southern Africa contributes over 20% of the intertrade trade that happens on the African continent. So with the challenges of AGOA coming in, there's a ripple effect. So on the West African side is the challenge of ECOWAS with the Sahel instability, and on the Southern African side you've got the AGOA implications with regards to it being renewed. So all of these ultimately have a huge impact with regards to the FCFTA. So it's all good to talk about we need 100 ships to unlock trade and investment with the FCFTA, but if the politics don't come right from a continental perspective as well as a global perspective, then we've got a big challenge.
Isn't trade suddenly a hot issue for all sorts of reasons at the moment? It really is. So I must tell you, Rotendo, before we do the next issue, I know many people listen to this program while they're cooking and then eating supper, and there has been a big shock in the olive oil sector in Tunisia.
Yeah.
The last thing the world needs is high olive oil prices. What's actually happened?
So Tunisia, believe it or not, is the second biggest supplier of olive oil in the world. It actually follows Spain, which was actually, I think Spain and Turkey are the leaders, followed by Tunisia. The challenge that has happened there, I don't know what's happening all over Africa. The CEO of the big olive oil company there has been arrested, and apparently the president Kais Saied was a bit unhappy in terms of the guy was underselling or undervaluing a lot of things. But if you look at the olive oil industry, it's a $15 billion industry. Tunisia itself exports about 1.5 billion per year. So there's a huge opportunity. The industry took a bit of a knock last year just in terms of growth, because I think there was drought in the region and one or other challenges. But at the end of the day, 47% of the country's food exports is olive oil, and 7% of the overall exports of the country. So it's a huge opportunity for investment and growth. And from an economic perspective, there's a lot of creativity around that with regards to olive oil. So I think with what's happening in that country, if we don't sort out the political issues, it always has a roll-on effect with regards to the multinational, with regards to productivity, and with regards to increase in terms of growth. Talking again in terms of the opportunities versus the challenges of the African continent.
It's also, it's a big exporter, isn't it, for Tunisia? They really need the revenue that it brings in.
Yeah.
It's also sustainable. It employs a lot of people because you need to harvest olives, things like that. On every level, this is something that matters to them.
Yeah, it does. And I think one of the key things that it talks to, just from an African perspective, is that we always see these things, and we've highlighted this a number of times, Stephen, in terms of we've got the industries. The big thing about growing the African economy is industrialization. And industrialization is meaning that we've got the agricultural land, we've got the mineral resources, we need to invest in manufacturing. That manufacturing translates to jobs. Those jobs translate to employment, et cetera, et cetera. The challenge that we have now is that when there is political interference like has happened here, and the CHO is actually a Tunisian company that has done very well. They've done very well in Tunisia. They've done very well, I think, even in Canada, in Europe. And the challenge that is there is that when we have this instability between the politics and the economy and the private and public sector, it doesn't bode well for the region or the continent. And there's a big loss if these guys don't sort it out.
Thanks very much indeed. Dr. Rotendo Ndwengi, Founding Director at Tribe Africa Advisory, author also of Rumble in the Jungle Reloaded.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, coming up in a moment, we'll hear from Warren Ingram. He's a certified financial planner at Galileo Capital. He's going to take the worry out of January for you, or the worry out of Janu, I suppose I should say. He's actually been looking at how to prepare from a personal finance perspective for probably the biggest spending season of the year. It's about presents. It's about how you make sure you don't spend too much money at the wrong restaurant. It's essentially about how you actually manage the money that you're going to spend over the festive season. You really don't want to miss it. And if you do, or if you think there's someone who needs to hear it, might be your partner if you're brave, you can send them the podcast afterwards, but it will be available just a few moments after. Warren Ingram is coming up next with everything you need to know to survive the actual festive season. If you think about how much money you spend over this time, give yourself a December budget and see how you do. I think you might kind of be shocked when you come out of it. And of course, I realize that having a budget in December takes some of the fun out of it, but gosh, it'll make January so much easier. You at The Money Show, the time now, of course, just gone 7:30.
The Money Show.
Personal Finance with Warren Ingram.
And of course, Warren Ingram's the certified financial planner at Galileo Capital. He's happy to get you into the festive mood, but only if you promise to spend your money wisely. Warren, I'm not going to call you the Grinch. I would actually call you the Father Christmas of January. How's that? Are you comfortable with that?
I love it. Thank you.
Okay. You want to prepare for the festive season to prevent a bad start to the new year. And we all know you all wake up in January and you're all like, oh my word, how did I get here? One of the things you want to start off with is actually, you want to make sure that that doesn't happen. So you can plan for January if you like. You start by creating a gift list.
Yeah, I think if we leave these things to the last second, we end up buying for everybody also in the anticipation that they might be buying for us, and we kind of build up this pressure on ourselves, and so we just buy, and before we know it, we've overspent just on gifts before we've even got to meals and entertainment and all those other things, and from my perspective, the reason we should be talking about it now is we've got time to think about it, to plan carefully, and so I think write that list of people that you really want to give a gift to, and then secondly, assign a spending limit. Decide how much you can afford to spend on a gift for each of them, and then add it all up and see what that's going to cost you, because that might help you make some better decisions, Stephen, around are you already overspending? And I think often we're so worried about what other people think, how they're going to feel about this gift. Am I spending enough? And I'm not sure that you should be measuring the value of that by a monetary amount. It should be about the thought that you put into it.
So what you're basically saying is budget properly for the Christmas presents that you have to give.
Yeah, and maybe as a follow-up, especially when it's larger families and larger groups of friends that you might be getting together, and now you feel pressure to give gifts to everybody, speak to all those people before the time and say, why don't we all of us just skip the gifts for this, and for the very young kids, let's get them something, but let's keep the limit to X number of rands, and so that takes the pressure off you buying for another adult that you don't know that well and overspending again, and I bet you it's a heck of a favor you're doing for them, because they probably feel exactly the same way. One of my friends said to me, let's not do gifts, let's just go Harvey's on a lunch. And I thought that was a great idea. I can't really bear getting another pair of socks, and I would really like a nice lunch. So I think those kinds of ideas around communicating and listing, to me, make all the sense in the world.
I mean, the other way you can do it, there are variations on this. And I know groups of people who will say, each adult is going to buy one other adult a present, and someone works out what that list is. You know who it is. You know who it's from. And so everyone gets one present, and everyone only has to give one present. And that really brings your cost down.
I think it's a great idea. I still think for a lot of us, over a certain age, we'd probably prefer not to have to buy those other people gifts. I know I'm the world's worst thinker of what to buy someone else, and I always feel like I'm giving lame gifts. And so if the pressure's off that I only have to buy one, that would be great. But even better if I don't have to buy any, especially if I know I'm not expecting any.
Well, now that you can't give anyone CDs anymore. You also want to talk about alternative gifts. What do you mean by alternative gifts?
So this is called a husband observing his wife. My wife loves to crochet, and don't ask me why. It's something she really enjoys, and I can't get it. But what fascinates me is how touched people are when she gives them the crocheted gifts to friends. And I mean, I'm not saying the youngsters. I think young kids, find handmade stuff really like. Not that exciting, but certainly older people really appreciate the effort that went in and the thought, and that got me thinking that actually, there is a lot we can do with creating thoughtful gifts for people, and not necessarily just buying kind of really expensive, presence. And I think, again, especially if it's something that's unique to you, the way you do something that everyone knows is unique. In this day and age, we can get so much that's the same. We can just go onto some big online sites and buy thousands of things that all look the same, and everyone can get them everywhere. And so we start to look for the things that are unique and specially made just for us. And whatever your kind of skill is, if you can make gifts for people, I think people will really appreciate that. Especially, again, it's about the thought that you're putting into this and the effort that you've put in. It takes no effort to go and buy a voucher for an online website. Trust me, I do it every year.
And then, the other big expense, you spoke about lunch earlier, but you end up eating out a lot more, doing a lot more things around food, and it's all good food. It's more expensive food. How can you keep tabs on that?
Number one, we live in a very warm country, especially over December. Why on earth are we kind of falling to the Western traditions of very big, expensive lambs and gammons and all the other things that people tend to do? We're kind of copying what we see on TV, I think. And to me, number one, why don't we change this? And actually look at the things that we can buy in our country that are suitable for very hot summer's days or summer evenings, and especially if you focus on those more seasonal kinds of foods, they tend to be a little bit cheaper. They're certainly much more appropriate for the time of year, and frankly, most of us would enjoy them more than big, heavy meals that are much more appropriate for very cold weather. So I think focusing on the meals that you're going to make, especially if you're hosting big gatherings at your house, rather change the whole menu. And again, speak to people about it. One of the things that you can do is tell the people that are coming that that you're kind of cost conscious this year. Times are tough. Everyone knows. So why don't we all split the menu down, and you bring X and I'll bring Y, and and so on and so on. And I think if you get guests to bring specific dishes, they feel useful. They feel like they're not just draining your finances, and second, and for yourself, it drops the costs a lot. And then we live in the country where the braai was developed. Bringing braai is a great way to entertain, and everybody loves doing it, and it's much cheaper for the host. All you've got to do is supply the fire.
Indeed. The sort of idea of bringing braai really does keep costs down dramatically, doesn't it? You encourage people to bring their own thing, and then you basically share it all out. And this is something that humans have been doing for generations.
And again, from personal experience, lots of people are kind of fussy nowadays, and especially seems to kind of translate to their children as well. So it's huge pressure on the host to try and, provide the gluten-free, dairy-free, feels to me taste-free food sometimes. And so, especially for people that have picky habits or maybe, big health issues, saying to them, look, why don't you bring meals that are appropriate for you? We'll, other people will bring meals appropriate for them, and we can lay them out, and there'll be some food for the more traditional meat and potato eaters as well. And it becomes much more festive. I feel the pressure on everybody reduces a lot. This is meant to be a good festive time of year. It's not just about spending a huge amount of money. It's about really enjoying yourselves, and in a nice environment where everyone's a lot more relaxed. And I don't know about you, but when I've gone to these lunches, the hosts looked absolutely frazzled and really stressed out and running around like mad people, and no one enjoys an experience like that. I think bringing braai, if I had my way, that would be the way we would do all of these festive season gatherings.
The other thing is, you talk about embracing local activities, because one of the things you want to do is you want to take the children to this, you want to go to that, you kind of want to go to the thing that everyone else is going to. You're suggesting there are alternatives.
The nature of our country is that wherever you live, there are opportunities to use what's around you for entertainment. So, if you live at the coast, there is always the beach, and it should be used. When you live in a mountainous place, there are usually lots of great places to go and do picnics and the like. And I think it's wherever you are, there are opportunities to do that. Lots of towns, if you live in a small town, they'll be doing markets and and special kind of street festivals, etc. And all of those things are either entirely free or very cheap, and especially things like picnics where you might pay an entrance fee but you can bring your own food, etc. So I think again, focus on those kinds of things, especially if you want to do them in groups where the group gets together somewhere. It's not at your house, so you're not left with the cleaning bill, and everybody gets to spend time in a much more relaxed way. And I think the reducing the costs of your entertainment really helps, especially when, as you said, there might be big concerts or big shows, and yes, if you've got young children, they might be really upset with you for a day or two, but guess what? They get over it, and they'll enjoy the time with their friends in a nice, relaxed environment, and that's the focus here. I think on quality of the engagement rather than just spending money on some artificial event for 2 or 3 hours.
I suppose overall you also monitoring your spending. So it's easy to go out and do things and kind of lose track a little bit. And you're suddenly presented with the credit card bill in January.
Yeah. And you spoke about January, and very often when we get people phoning in, at that time of year, they kind of say, I don't know how it happened. And the reason is because it's very easy to tap and go on your phone nowadays, or to swipe the card, or to do the online shopping. And unless you're keeping a careful track of what's going on, you do end up in a situation 2-3 weeks into January where you have a huge bill and no money to kind of get through the month. And so my suggestion is, number one, do everything early. So do your shopping lists early. Make sure that you've got that whole kind of list of who you're going to spend on and what you're going to spend on them, and then get it done very quickly and very early. I think it also takes some of the pressure away of having to buy gifts at the last minute when there's not much available, and all that's left are the really expensive things or the real rubbish. And then secondly, it allows you to do this in a much more controlled fashion, and so you can monitor what you're spending, and it doesn't creep up on you, kind of like a steam train. And so controlling your spending is a few things. It's one, it's doing it early. 2, it's tracking regularly. Every second or third day, make sure you're checking your app on your phone to see what those expenses are. And then, doing it consistently over, if you do it over a 2-month period, at least you're spreading that cost out as well. So hopefully by the time you get to January, you're starting the year off at least neutral, if not in a better position. And the big thing here, I think, is doing everything last minute kicks in that impulse buying. And for me, impulse buying is lethal to overspending. It's just the absolute way to make sure that you're never going to stick to a budget.
We're talking to Warren Ingram, Personal Finance, tonight. How he is the Father Christmas of January. He removes the January from your calendar. In a moment, we get an answer to this question. This is from Rafilwe. Rafilwe says, I'm 26-year-old. I'm new at investing. I noticed that there are unit trusts and ETFs, exchange-traded funds available. Which should I choose? Interesting question. Unit trusts versus exchange-traded funds, and particularly the age that Rafilwe is at, 26, just starting out. We'll get an answer from Warren in just a moment.
The Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, a certified financial planner at Galileo Capital. Rafilwe's question, I'm 26 years old. I've noticed that there are unit trusts and exchange-traded funds available. Which should I choose? And I suspect here, Warren, the fact that Rafilwe is starting out, 26, a long way to go until retirement, that might be key to this question.
Age is a huge factor, Stephen. You're right, because if you've got another 25 years or 30 years of work, that means that you can afford to take a significant amount of investment risk with your investments. In other words, you can allocate a large proportion to the stock market. Someone of Rafilwe's age can actually do 100% of her money in shares, and so the starting point on a decision like this is, what's my mix of assets? And always the first thing I'm going to say is, make sure you've got your emergency fund sorted out first, please. Don't start investing until you've got 3 to 6 months worth of your expenses in a money market account that you can call on in an emergency, and then get going on your investments. And so you need to find something that's got a very big exposure to the stock market. a much smaller exposure to cash or government bonds or property companies. And this is where life gets a little interesting, because years ago, that simple answer would have been, just buy an exchange traded fund, because you can do it with small amounts of money. The costs of exchange traded funds are very low, and they are the clear winner. But as we know with financial services companies, they never stand still. So the unit trust company looked at this, and I guess they started losing market share, and they woke up to a reality, which is that they're also going to need to compete. And so now, Stephen, you're in a position where you can buy, for example, a global stock market index. They're called feeder funds, and you can buy it in a unit trust, or you can buy it in an exchange traded fund. They do the exact same job. Nowadays, they often cost the exact same amount. It's just the way you buy them is different, and the transaction costs have an implication. So what that means is, if you're in a position where you're doing a monthly debit order, I would actually suggest that you look at a unit trust, because the unit trust companies don't tend to charge you to buy the unit trust or to sell it. So there's no transaction charges, and they're well set up for debit orders. If you're investing lump sums every now and then, and you're not sure when the money's going to come in, and it might be 500 Rand now and 2,000 Rand later, and maybe a bigger amount and then a smaller amount again, then I would suggest that you look at exchange traded funds, especially if you're comfortable with a little bit of complexity around buying those exchange traded funds and then monitoring them on an app or online, because it's not really fire and forget with exchange traded funds when you've got an app. And the other point there is that they will have transaction costs. So they're going to charge you some money when you buy the exchange traded fund, and one day when you sell it, which is hopefully in a very long time away, they're going to charge you to sell it. The tax implications of the two are exactly the same, and all the other things could be identical. So I think I know I'm sitting on the fence a little bit, Stephen, but I think the answer is debit orders, go the unit trust route, and odd amounts at different times, especially smaller amounts of capital, I would look at exchange traded funds. But the core question here will be how much you allocate to shares. And I feel, a large or 100% allocation to shares is right. And maybe you do half in the South African index and half in a global index, and just keep doing that for the next 20 years and call us back if we're both still on air and say thank you.
I love the optimism. I mean, you can tell someone who knows their stuff. Talking about that, Warren, I mean, when we get back to the sort of holiday theme and making sure that you actually have some money in January, I mean, one of the things about it is that this is a time of extravagant spending, but it doesn't have to be. I mean, the money is important. It's what you and I do. But actually, and I hate to sound like the American movie, but Christmas isn't supposed to be about that. You're supposed to reflect on family, really.
It's exactly right. If you talk to, I'm not going to say teenagers necessarily, that they're in a different category, but if you talk to children and you ask them, and they've done these surveys many times, what would you prefer? Would you prefer a gift, or would you prefer to spend time with your parents? And the answer is almost always universally time with my parents. And in the holidays, if you don't have money, the one thing you've got potentially is time. And spending quality time engaged, actually, not sitting on a screen, but engaged with your children, engaged with your loved ones. Grandparents want to spend time with you. They don't want to, kind of go to a concert, I promise you. And so it's very rare that people don't appreciate the actual time together and create those opportunities and focus a little less on the gifts. And it depressurizes the whole family when money's tight and gives everybody what they actually really want. The gift is only new for a few seconds, and the enjoyment is new and fun for a little while, but the memories last.
Yeah, it's so true. And I mean, there's plenty of research that really tells us that. Father Christmas, Warren Ingram, the Father Christmas of January, co-founder at Galileo Capital and a certified financial planner. Thank you very much indeed, Personal Finance, this evening.